The single biggest barrier to day trading US stocks has been removed. Here's everything you need to know. What's up, everyone? Today we're talking about something that just changed the game for every retail trader in the United States, and honestly, for traders around the world who have been waiting to access US equities. But let's start from the beginning because context matters here. What the PDT rule was. Back in 2001, right after the dot-com crash, US regulators watched thousands of retail traders blow up their accounts, making aggressive, high-frequency trades without enough capital to absorb the losses. The response was the Pattern Day Trader Rule, the PDT. The logic was simple. If you made 4 or more day trades within any 5 business day period in a margin account, you'd get flagged as a pattern day trader. And once you were flagged, you were required to maintain a minimum of $25,000 in your account at all times. Drop below that number, your broker locks you out. Some brokers would freeze accounts for 90 days. For 25 years, that rule acted as a hard gate. And for a generation of traders, that rule forced workarounds, cash accounts, future markets, offshore brokers, splitting capital across multiple accounts just to get around a number that hadn't been updated since the dot-com era. What just changed? On April 14th, 2026, the SEC, the Securities and Exchange Commission, officially approved the elimination of the PDT rule. The proposal came from the Financial Industry Regulatory Authority, the independent regulator that oversees US brokerages. The rule has been formally reviewed since late 2024, arguing that a regulation built for 2001 technology had no place in modern markets where commissions are zero, execution is near instant, and retail traders have access to institutional-grade tools. The proposal received over 100 public comments letters. Only one was against it. So what replaces the PDT rule? A real-time, risk-based intraday margin system. Instead of counting how many times you traded, brokers now monitor your actual intraday exposure dynamically. Any margin account above $2,000 gains access to day trading stocks. The shift in philosophy is significant. The system stops asking how many times you traded and starts asking how much risk you are actually carrying right now. The official effective date is June 4th, 2026. Brokers have up to 18 months to fully implement the new framework. If you have never tried BlackArrow, now is the right time. The free trial requires no credit card and no commitment. Link in the description down below. Now, let's talk about what this actually means for your trading. Why this matters for you as a trader. First, access. The single biggest barrier to day trading US stocks has been removed. You no longer need $25,000 sitting in an account just to trade actively. This is a fundamental shift in who gets to participate in the largest equity market in the world. Second, opportunity. More traders entering the US equity market means more volume. More volume means more liquidity, more intraday volatility, and more setups, especially for strategies built on order flow, tape reading, and DOM analysis. Third, and this is the one that matters most, accountability. The new system does not protect you by limiting your trade count. It exposes you to the market based on the risk you choose to carry. That means risk management, position sizing, and the quality of your execution tools have never been more important. This is exactly where BlackArrow comes in. As the PDT rule disappears and more traders flood into US equities, the traders with the best infrastructure win. Super DOM, volume profile, aggression alerts, server-side execution that never freezes at the open. The door just opened. The question is not whether you will take advantage of this. It is whether you will have the right tools when you walk through. Link in the description down below to try BlackArrow for free. See you in the next one!